Hi, this is Rosario Borgesi. Stablecoins are one of the most important innovations in DeFi. In this video, we will break down how they work, explore the different models behind them, and see how protocols like Sky operate in practice. Let's dive in. In this video, we will explore what are stablecoins, the various type of stablecoins. We will also make a deep dive into Tether, which is a fiat-based stablecoin. We will also talk about in detail about USDS, formerly DAI, um, which is a crypto-based stablecoin, and it is managed by the Sky protocol, former MakerDAO. We will also explore the TerraUSD, which is an example of an algorithmic stablecoin, and we will also have a demo session where we will see how to buy this stablecoin and how to mint DAI and how to use the saving program of the Sky protocol to earn by depositing USDS in the Sky protocol. So let's start by understanding why we have why these stablecoins have been invented. The main reason is that crypto is powerful but is very volatile, so we have something that can range from $0 to $4,000, and for everyday use it's not very useful. So in fact, it goes up and down. BTC is great for value. Of course, it is a store of value, but in the long run, it is not cannot be used for to buy a coffee, for example. And of course, you can price loans or salaries in something that moves 10% a day. So DeFi needs price stability, and that's why have been invented stablecoins. So, what is a stablecoin? It is a crypto token, crypto asset that is designed to stay stable, and it is usually pegged to a fiat currency. The most common peg is to the United States dollar. So these USDC and USDT and DAI are three examples of stablecoins that are pegged to the dollar, but there are also stablecoins pegged to the one, to the euro, to the Mexican pesos, or also to gold. There are many types of stablecoins. So why we need stablecoins for practical payments? Because as we said, we want stable prices, not volatile, and that are suitable for everyday spending like coffee or groceries. We want to use them to pay abroad all over the world, so we don't need an approval from a bank. We don't want a currency conversion. We don't want a cross-border check, and we want something that works anywhere there is an internet connection. We want low fee and fast payment, so we want to pay instantly worldwide, and we want the fees to be lower than traditional payment rails. And we also need stablecoin because they operate as a bridge between crypto and the real world. So they are denominated in familiar units like dollars or euros, and they are easy to on-ramp and off-ramp. Um, um, they provide, let's say, quick way to do, and also an easy way to do non-ramp and off-ramp to DeFi without volatility exposure. So these are the properties that make a stablecoin similar to money. It is a store of value, medium of exchange, unit of account, standard of deferred payment. Why? What does it mean to be a store of value? Basically, it has to answer these questions. Can it preserve value over time? For example, Bitcoin, of course, accrues value over time, but it is very volatile in the short term, while stablecoin are very stable in the short and medium term. Medium of exchange. Can it be used to pay and receive payments? Bitcoin, since it is very volatile, makes payments unpredictable, while stablecoin, if you stablecoins, prices are predictable. Unit of account. Can we price things with it? In Bitcoin, it is very difficult because prices fluctuate. Using stablecoin, it is ideal for pricing goods, loans, and so on. Standard of deferred payment, which brings to the questions: can we use it for future obligations? Bitcoins cannot be used because the debt value can change dramatically. Instead, we can use stablecoin because they are ideal for loans, subscriptions, and payroll. So the three types of stablecoins are Fiat-Collateralized Stablecoin, Crypto-Collateralized, and also Logarithmic. The example most famous of each type, for example, for fiat-based stablecoin, it is USDC and USDT. For crypto-collateralized DAI, nowadays USDS, algorithmic stablecoin USD or TerraUSD. So let's start by exploring very briefly what are these fiat-collateralized stablecoin. The collateral are fiat reserves, so dollars or T-bills or cash equivalent, and they are held off chain by centralized entities. So the mechanism is very simple. When you buy a token, for example, one USDT, you are buying a dollar. So you have to trust Tether in this case, or for USDC Circle for USDT Tether, that they actually have this dollar in their reserves. So later on we will see a breakdown of USDT reserves. But basically here the question is that the point is that one token is equal to $1, okay? And we have to trust Tether that there are actually dollars in their reserves. So these tokens are redeemable through the user. This means basically that we can exchange one token, one USDT for $1 anytime. So the pros are that these tokens are very stable and are widely used. The cons are, of course, that are centralized. We have to trust in the issuer and are subject to regulation and censorship. What does it mean? So, very stable, of course, because are backed by fiat money, widely used, of course, because everybody understands dollars and maybe more than Bitcoin, and they are centralized because there is a central authority that we have to trust in order to use them, and anytime the central authority can, for example, freeze our token. So we have to trust them, but this is necessary in order because they are subject to regulation, so they have to comply to the laws of the government in each nation. And of course, when we use these tokens, we have to trust this Circle for USDC and Tether for USDT to that they do not blacklist our and um, let's say so that so that they basically don't prevent us to use this token. So there is a very good real use case for these fiat-backed stable coins. Uh, and the problem is that in many countries there is limited or no access to bank accounts, and the local currencies are subject to high inflation. And or also, there are expensive or unavailable international payments. The stablecoins provide a solution, especially the fiat-backed stablecoins, like we said, USDC and USDT, because they provide digital dollars without a bank account, protection from local currency inflation, fast global transfers. So they have a clear and very important use case that is helping a lot of people all around the world. Let's talk about crypto-collateralized stablecoin like DAI. In this case, the collateral it is represented by on-chain crypto assets. So while before we had off-chain assets like T-bills or USD dollars, in this case, the collateral is represented by crypto assets, so Ethereum, wrapped Bitcoin, other USDC, and so on. They are over collateralized, as we will see in detail later on, because, for example, one DAI requires $1.5 of assets. And the mechanism is very simple. Users lock collateral, they mint stable coin below collateral value, and liquidations protect the peb. The pros is that they are transparent and decentralized. Instead, the fiat-based are centralized and not very transparent. And the cons is that they are the capital inefficiency, of course, because I have to provide more collateral in order to have to mint a stable coin that has a lower value. They are more complex, and there are liquidation risks during volatility. There is another type of stablecoins represented by algorithmic stablecoins like TerraUSD, or also called UST. In this case, there is no collateral, no real collateral. The mechanism is very simple. The mechanism is more complex in sense that supply expands and contracts. The peg is maintained via incentives and arbitrage, and it relies on market confidence. Pros, of course, capital efficiency, there is no over collateralization, scalability, easier to grow supply, cons, extremely fragile, prone to death spirals. You can see all the Tether tokens in circulation. These are 183 billions, more or less, or of USDT that are in circulation, that are backed. This is um, the token that is pegged to the dollar. Okay, so it means basically $183 billion. This is instead the token that is pegged to the Chinese yuan. And we have another, they've issued another token that is pegged to the Mexican peso. And here, the last token that they have created, it is XO, which is a gold-backed stablecoin. As you can see here, it states all Tether tokens are pegged at 1-to-1 with a matching fiat currency and are backed 100% by Tether's reserves. Here you can see all the balances. For example, USDT on the max, the greater part of USDT, of course, is on Ethereum. Here we can also see the details about all the chain. Okay, here there are also the contract. Okay, this is interesting, but I wanted to. So there are 96 billions of USDT on Ethereum. This is important. Of on 183 billion of USDT, so maybe half of the USDT are on Ethereum, and I think they are considering here all the chain, also layer 2s, because of course they are not only on Ethereum mainnet but also on layer 2. What is important to check out is this part, report and reserves. You can see that the breakdown of the reserves of USDT, because they claim that of the overall value of the asset, which is uh, this one. This is the overall value of the asset that are backing the tokens. Okay, so 76% is invested in cash and cash equivalents and other short-term deposits. Then they have a 4% of Bitcoin, another 9% of precious metals, and here secured loans. I think, okay, this part here, there is an also, they make a deep dive in this part. So they say that cash and cash equivalents and other short-term deposit, there is a breakdown which is 83% US Treasury bills, here overnight reserve repurchase agreement, term reverse repurchase agreement, and so on. So basically, the greatest part of the collateral, let's say, when you buy Tether USDT or another stablecoin, this is the reserves that these are the reserves that Tether keeps in order to back that back your the tokens that you buy. So most of them are US Treasury bills. Now let's talk about USDS or formerly DAI. Let's make a breakdown on the history of this protocol. In 2017, it has been created the single collateral DAI. The MakerDAO protocol introduced DAI in December 2017. So users could generate DAI. It was the only supported collateral, and this was the first implementation of a decentralized crypto-collateralized stablecoin. In 2019, they have introduced the multi-collateral DAI. So in November 2019, the system was upgraded. It was added the support for multiple collateral asset types, improved the risk managed. This brought a more scalable and resilient system. In 2024, the Sky, there has been the Sky ecosystem rebrand. So MakerDAO became Sky ecosystem, and the DAI was rebranded to USDS. So that's why we most of the time hear about MakerDAO and DAI, but nowadays they have been replaced by Sky and USDS respectively. So has been created the Sky protocol. How USDS is governed. So the Sky protocol is governed by a global community. The governance is performed by holders of the Sky token. And what are the governance mechanism and mechanics? The Sky protocol operates as a DAO. Sky is the governance token of the Sky protocol. One Sky locked in a voting contract equals one vote. Voting is executed fully on chain. So basically, if you have this token, you can vote for proposal and decide and take part in the decision that the Sky protocol takes. Everything, of course, on chain, because this is a DAO. What governance controls? So the governance controls the collateral types and risk parameters, stability fee and saving rates, system upgrades, and protocol changes. So the key idea here is that the Sky protocol is not run by a company and it is run by on-chain governance. So let's start talking about the Sky stablecoin. So DAI is a decentralized collateral-backed stablecoin. It is soft pegged to the US dollar, so one DAI is typically equal to one USD. That's the purpose. We want one DAI equal to $1. How it is created? The user deposits collateral into Sky protocol vaults. DAI is generated against the collateral, and this is basically how the new DAI enters circulation, and user gain liquidity without selling their asset. So this is important. In the case of, for example, USDC or USDT, if you want to buy them, you, for example, you have it, you sell your it to buy an equivalent amount of let's say USDT. So for example, if it is worth $2,000, you sell your it and gain 2,000 USDT. In this case with DAI, for example, I am in the case where I don't want to sell my it, so I want to be still exposed to it, but I want to use to have a DAI to use for whatever reason. So I can lock and provide my DAI, my to the protocol, to the Sky Vault, and the Sky Vault gives me DAI. This is the basics of why we have introduced this DAI stablecoin. So how people can get DAI? They can generate it, they can mint DAI from the vaults by providing collateral, or of course they can buy it on exchanges or from brokers. If there are already minted DAIs, we can buy them on any exchange or Uniswap or whatever. We can receive it as a payment. And so once DAI is obtained, we can send it on chain, we can use it to pay for goods and service, and we can hold it as saving, and by locking it into the DAI into the DAI protocol by using the DAI savings rate. So we, as we will see also in the demo, we provide our DAI or our USDS, and we get an interest from the protocol. So what backs DAI? Everyday DAI is backed by excess collateral. So the collateral value must be greater than DAI debt. All positions and transactions are transparent. Of course, it is fully viewable on the blockchain. And only collateral assets that are approved by the Sky protocol governance can be used to generate DAI, each with specific risk parameters. So let's start talking about the USDS stablecoin. In this case, let's say that talking about DAI and talking about USDS, or talking about MakerDAO, talking about Sky protocol is pretty much the same thing, okay? Because nowadays since there has been the rebranding, we will always talk about DAI for historical reason, but nowadays it is USDS. Okay, so saying DAI or saying USDS is mostly the same thing unless we are analyzing the history and the evolution of the protocol. So, in 2024, MakerDAO rebranded into the Sky ecosystem and was introduced USDS. USDS is the successor to DAI. Of course, it is decentralized, unbiased, and collateral based, and is soft pegged to the USD, US dollar. So, same principles. USDS is an IOU token representing a collateralized balance in the Sky protocol, just like DAI. So the principle is the same, but as we will see later on, USDS has, when it has been created, it has been associated with an improvement of the formerly DAI. So how is USDS different from DAI? Same core use case, so we want a stable coin, but it was designed to scale for global real-world adoption, and it aligns with the industry standards for large-scale RWA-backed stablecoins. This we will see later on what it is. So this is a trade-off that aims to increase security, stability, and reliability at scale. So how we can get USDS? We can convert DAI to USDS. Don't remember that these two, even though there has been rebranding, are two different tokens. So DAI and USDS are different tokens, but we can convert DAI to USDS using the DAI to USDS converter. So this is free, one-to-one, infinitely liquid conversion. You can swap DAI and USDS at any time. There is no slippage. And there is also the Sky, you can get, of course, USDS if you provide USDS to the Sky protocol with the Sky saving rate, as we will see. So you deposit USDS and you accrue interest with other USDS. And of course, you get a yield, and this is designed for savings and yield. So let's talk about now also you can get the USDS with the Sky token rewards. So you receive USDS through protocol incentives. So basically rewards for participating in the ecosystem, and of course you can get USDS in the exchange or DeFi protocol, basically swapping for instance Ether for USDS. So it is available on third-party exchange and can be obtained via DeFi applications. Let's talk about Sky Vaults. What are Sky Vaults? Sky Vaults are smart contracts used to generate USDS. So users deposit approved collateral assets. Collateral is locked in a vault. USDS is minted against that collateral. Vaults are fully non-custodial. What are Sky Vaults? So let's make an example. So it is a smart contract, as we said. So for example, the user deposits 5,000 worth of it, and against this collateral receives 10,000 worth of USDS. So what happens on chain? It is locked inside the Sky Vault. USDS is minted and sent to the user. So the vault now has a collateral, 5,000 worth, $5,000 worth of it, and a debt of 10,000 USDS that the user has to repay. What are the key properties of the Sky Vaults? It is they are non-custodials, so users interact directly with the smart contract. There is no middleman. They are over-collateralized by design. Each vault tracks the collateral. So, for example, the debt, the USDS minted, the stability fee, and the vault safety depends on the liquidation ratio. What does it mean over collateralization? It means that you must lock more value, collateral, for example, it, than the USDS that you generate. So the collateralization ratio is basically the ratio between collateral value you provide against the debt, which is the USDS you mint. So, for example, if you deposit $5,000 worth of it, this is the collateral. You generate, for example, $8,000 of USDS. This is the debt. Your collateralization is basically the ratio between it and the USDS, and it is 187%. So this protects the system from price volatility. So this is similar to when you go to the bank and you ask a mortgage for a house. So the collateral value, it is the house, and the bank will never give you 100% of the value of the house, but will loan you. So your debt will be, for example, 80% of the value of the house, something like that. Not never 100%. This is very similar, but of course, in this case, since crypto is more volatile, there is a an higher collateralization ratio. In fact, what is the maximum amount that I can borrow? So the maximum amount that we can borrow, it is the liquidation ratio. So basically, the maximum amount we can borrow is when the collateral value divided the ratio between collateral value and debt is equal to the liquidation ratio. So basically this ratio here has to be always greater than the liquidation ratio, otherwise we are at risk of being liquidated. So for example, if we deposit 50,000 worth of it, and we mint 10,000 USDS, we are at 150% of the collateralization of the collateralization ratio. Of course, it would be better if we would have minted less USDS, so this ratio is higher. If this ratio is, for let's say, 180%, 200%, it is better than 150%, because if you go below this value, you are liquidated. Okay, so we want always this ratio between collateral value we provided and that to be always greater than the liquidation ratio. Otherwise, we will be liquidated and we will lose our collateral. So how can we interact with the Sky Vault? The first step one is to create a collateralized vault. So we can create a vault via Summer.fi, formerly Oasis Borrow, or a community interface, as we will see later on, DeFi Saver, InstantApp, so on. So basically, via these two applications, the user can deposit a specific collateral type. Once funded, the vault becomes collateralized. Each collateral type requires its own vault. Step 2, we need to generate USDS. So the vault owner chooses how much USDS to mint. The collateral remains locked in the vault. USDS is sent to the user's wallet that is created inside the vault. So generate USDS means that we are creating an obligation to repay it. So this is basically that we have to repay it. Step 3 and 4, we have to repay and withdraw. So pay down the debt. So the user repays the USDS minted plus the stability fee, because you have to pay a fee each year in order to borrow this DAI, and is paid in USDS. Of course, the fee accrues over time. and we can then, once we have pay down the debt, we can withdraw the collateral. So once that is repaid, collateral can be withdrawn, vault can be reused or left empty. So important notes. Vaults are independent. Users may have multiple vaults, different collateral, different risk parameters. Falling below the liquidation ratio triggers liquidations. Stability fee. What is a stability fee? The stability fee is the interest paid on the USDS you mint or generate. So it accrues continuously over time. It is paid in USDS. It is set by the Sky governance. For example, if I mint 10,000 USDS, the stability fee is 5% per year. After 1 year, I have to repay $10,000, which is my debt, plus $500 of USDS, which is the stability fee. So let's talk about liquidations. Why liquidations exists? Liquidations protect USDS stability, so they protect the protocol stability. USDS is created as debt against collateral. If collateral value drops, the system must protect itself, otherwise it becomes insolvent. So liquidations prevent underbacked USDS. Without them, the stablecoin risks depegging. So liquidations are a safety mechanism and not a punishment. When does a vault get liquidated? So a vault becomes liquidatable when it falls below the liquidation ratio. The liquidation ratio is the minimum collateralization level a vault must maintain to stay safe. So there are two common causes that cause the liquidation to be triggered. If the collateral price falls, for example, it drops in value, or if the debt value increases relative to the collateral, so we mint basically too much tokens. So the moment when the liquidation is triggered is when the collateralization ratio, so the ratio between collateral value and debt, becomes lower than the liquidation ratio. For example, if my liquidation ratio is 150%, my debt is 10,000 USDS, the minimum collateral value is $15,000, for example, of it. If it drops and, for example, to $40,500, the vault can be liquidated because we are below the liquidation ratio. So what happens when our vault is under collateralized? It triggers the collateral auctions. So the vault is liquidated, the collateral is seized by the protocol, the collateral is sold through an auction. So the goal of the auction is to raise enough USDS or DAI, repay the vault's debt, and cover the liquidation penalty. So if the auction raises more than required, the remaining collateral is returned to the vault owner. Okay, so there is no stealing of collateral. Who triggers the liquidations? The keepers or liquidators. They are independent actors that monitors the vaults, automatically detect unhealthy positions, trigger liquidations on chain, and they are incentivized by liquidation penalties. Because of course they get a part of the collaterals plus a bonus. So they are basically getting the collateral at a discount price. Or if you want, in other words, they are getting more of the collateral for that price. Liquidations are permissionless and market driven. This decentralized keeper network is critical for stability, of course. What happens during a liquidation? So the vault becomes under collateralized, a keeper triggers liquidation, collateral is sent to auction, USDS debt is burned. So bear in mind that when we mint USDS, because we are providing collateral to the protocol, So we are minting USDS, so we are generating USDS new token. In this case, when we repay or during a liquidation, USDS that is burned. So these tokens are burned, are removed from circulation. Liquidation penalties applied. Any excess collateral may return to the vault owner. Let's talk about real world asset. This is an important topic when talking about USDS and the Sky protocol because this has been a great innovation. So, what are real world assets? Real world assets are off-chain financial assets that are tokenized for use on blockchain system. So, imagine that, for example, government bonds like US Treasuries, loans or credit facilities, real estate or commodities, all this stuff which is off-chain can be tokenized, so brought on-chain and used as a collateral in a vault. So these airways are basically a bridge between TradFi or traditional finance and DeFi. So why airways matter? Airways bring stability. So because they are less volatile than crypto, of course, real estate is less volatile than crypto. They bring diversification, new asset classes, and they bring real yield. And this is, of course, income from traditional markets. For example, T-bill. They allow DeFi protocols to interact with trillions of dollars of real-world capital. So why Sky introduced RWA vaults? So basically, before we started with DAI, with the vaults that had a single collateral, then DAI allowed multiple collaterals, so wrapped Bitcoin, for example, and also USDC. Now we are bringing also other assets into the vaults like real world assets. So as we said, T-bills, real estate, and so on. So Sky was one of the first DeFi protocol to use airways as stablecoin collateral. The goal is to expand the collateral base of the system and make it more stable. The benefits are to reduce the dependence on crypto markets because, as we know, they are really volatile, increase the system stability, generate yield for the protocol. The returns generated from airway strategies flow into the protocol surplus buffer. So traditional sky vaults use on-chain crypto assets like ETH and wrapped Bitcoin or USDT or USDC, prices provided by oracles, liquidations handled automatically. In the case of RWA vaults, they use tokenized off-chain assets, require legal agreements and custodians because, of course, there must be a third party that give us the approval to say that we can use, for example, a real estate as a collateral or a T-bill as collateral. They use a governance approved investment structure, and these vaults follow predefined rules described in the Maker Improvement Proposal or MIPs. Let's now also talk about the DAI savings rate. This is a really important topic. So the DAI savings rate allows anyone holding DAI or USDS, as we will see, to earn yield by depositing it into a smart contract. So how it works? Users deposit DAO into the SR contract, yield accrues automatically over time, funds can be withdrawn at any time, no minimum deposit required. So the purpose here is that the DSR creates demand for DAI by offering a native savings mechanism. This is very important for the price stability because governance can adjust the DAI saving rate to help stabilize the peg. So, for example, if DAI is greater than $1, to bring DAI back to the peg, so bring DAI lower to $1, the governance may lower the DSR, so can lower the yield we do to people that lock DAI into the protocol. So there is a reduction in demand, and of course we bring down the price. In this case, if DAI is less than 1, we want to increase the DSR, so we encourage holding of DAI and the price increases. So this DSR acts as a monetary policy tool. So there are two monetary policy tools: the stability fee, so the fee that you pay when you borrow borrow USDS against the collateral, and also here the saving rate, which is the yield that you get by depositing USDS. These two levers allow to keep the USDS or the DAI price to $1. So after the 2024 and the Sky rebrand in 2024 was introduced the Sky rate, Sky saving rate. Okay, the former was DAI saving rate. Okay, now for USDS was Sky saving rate. The key difference are basically that this was designed for USDS, using the ERC 4627 volt standard can coexist with the DAI savings rate. So basically it is the same thing as before, but it was designed for USDS, but the principle it is the same. So in fact, the purpose is to provide a native yield mechanism for USDS holders. Let's talk about the governance of the Sky protocol more in detail. So the protocol is governed by token holders. The governance responsibilities are to add the new collateral types, set risk parameters, adjust stability fee, modify the saving rate. Anyone can submit governance protocol proposal. Of course, they have to, and of course, token holders vote to approve or reject this proposal. I was saying that basically, if you have the Sky token, you can vote this proposal and so take part in the approval or rejection of this proposal, only if you have the token. Each vault type has specific risk parameters that are set by the governance. The key parameters include debt ceiling, so the maximum debt allowed for a collateral type, stability fee, so the interest paid by vault borrowers, liquidation ratio, the minimum collateralization required, and liquidation penalty, so the fee applied during liquidation. These parameters control the risk profile of the system. Of course, all these parameters are decided by the governance, so by voting with the Sky token. So let's check some of the USDS system metrics. The total debt is 11 billion of USDS. This is the amount of USDS in circulation. The total collateral is 13 billion. These are the assets that are backing USDS. So the collateral, of course, must be greater than the debt. The collateralization ratio right now is 118%, so the system is over collateralized. The estimated annual revenue is 423 million per year. Of course, this revenue comes from fee, protocol strategies, and RWE, and the source, of course, it is this page of Sky, the Sky application slash collateral. So what is the collateral that backs USDS? Stable, the mostly as we can see in the graph, stablecoin collateral, so USDC, then core or crypto collateral, ETH, and wrapped Bitcoin. It is this part here, core, this part here. Then RWA, like US Treasury, as we have said before, it is this legacy RWA, this part here. And of course, protocol lending asset like Spark, because this is another protocol that is also provided by the Sky ecosystem. How was USDS issued? So USDS enters circulation through multiple paths in the Sky protocol. By means of stablecoin swap, basically, as we will see, user can swap other stablecoin for USDS. So you swap USDC for USDS at 1-to-1 ratio. It was generated by Crypto-Collateralized vault, so user deposited it, wrapped Bitcoin, or staked it to mint USDS. Protocol Spark strategies. So USDS is issued via protocol managed lending and liquidity strategy, RWA based issuance. So USDS is minted against approved real world asset structures. Now let's talk about USD or TerraUSD, sorry, or the USD coin. So TerraUSD or USD was an algorithmic stablecoin built on the Terra blockchain, and it collapsed in 2022. I am talking about it because it is an example of purely algorithmic stablecoin, and I think that even though it collapsed, it is important to study why it collapsed, what was the design behind this protocol. So the goal was to create a decentralized, capital-efficient stablecoin pegged to $1 with no fiat reserves and no crypto over-collateralization. So as we have seen in the DAI protocol, the DAI protocol is based on over-collateralization. In this case, we want to provide we don't want an over-collateralization. So the core design idea is this. UST relied on a dual token system with Luna. Luna is the native cryptocurrency token of the Terra blockchain. So UST is the stable coin, and its target is $1. Luna is a volatile token that absorbs price fluctuations. So the peg was maintained via mint and burn arbitrage. So how the mechanism worked? When USD was greater than $1, user could burn one worth of Luna, mint 1 USD, sell USD on the market. So the USD supply increases and the price is pushed down to $1. When USD was lower than $1, users could buy cheap USD, for example at $0.97, redeem it for $1 worth of Luna, and sell Luna. USD supply decreases and the prices is pushed up to $1. So the key assumption here is that this only works if Luna has sufficient market value and demand. So USD was backed by, there was no dollars backing USD, no it, only the confidence in Luna's value. So there was basically no collateral behind this token. Why it was designed this way? For capital efficiency, so no over collateralization. $1 of stablecoin. I get $1 of stablecoin and I don't need to lock $1.5 of assets, like we have seen in DAI, for example, and it was very attractive compared to DAI. The other point is scalability. It is easier to grow supply and there is no need to source collateral. So this was the ecosystem flywheel. USD demand brought Luna burned, and so Luna price goes up. The system looks safer, and so more USD demand. This worked only in good market condition, of course. So why Terra USD collapsed? For reflexive dependency, USD's ability depended on Luna's price. Luna's price depended on USD demand. So here we come to the death spiral. Once USD started slipping below $1, users rushed to redeem. Massive amounts of Luna were minted. Luna price collapsed. This caused hyperinflation of Luna. USD permanently lost the peg. So, unlike collateralized stablecoins, in this case there is no liquidation mechanism, no reserve assets to absorb shocks, no guaranteed redemption value. So once confidence broke, nothing stopped the collapse. The first use case that we have for our stablecoins is to basically swap a token for a stablecoin of our choice. For example, in this case, we can use 1inch, which is a DeFi aggregator that allow us to swap tokens. And if you want to learn more, you can check out the video that I made on 1inch. But basically, it, as I said, it allows us to swap one token for another. So if I connect my wallet here, MetaMask, okay, my wallet right now has we are on base L2, has $10 worth of it. So we basically want to try to swap this amount of it for a stable coin. For example, I can here say swap. Pay it has already chosen uh, the chain which is base. I can select the token which is Ether. In my case, I want to swap, for example, for let's say Tether. And I, if I select this and let's say I want to swap the maximum amount, I can go on, of course, and swap it for USDT and gain, of course, USDT. Otherwise, we can swap, for example, for USDS, which is um, the new version of DAI, and maybe I don't want to swap the whole amount. Maybe I want to make something less, let's say 0.4. Okay, I want to continue with this swap. Okay, I must sign this and agree. This is the message I'm going to sign. Let's make this transaction. Okay, confirm. Okay, confirm transaction. Okay, so now let's see what we have in our wallet. Okay, I think we need to import the USDS contract to see it listed here on MetaMask, but we can see here on the portfolio in this part of 1inch that here we should see, okay, we have an amount of USDS, $8 and another amount of Ether which is $2 on the chain base. Okay, so it seems that the swap has been done. Another thing that I want to show you is how to basically borrow DAI tokens and providing to the protocol it. So as we said, So we have to interact with the Sky Vault. I will say that it's not we cannot do it from the Sky DApp. I'm using here this DeFi Saver application that allow us to interact with the MakerDAO vault. So we will explain how to mint DAI tokens by providing it as a collateral. Unfortunately, it's not easy to do it for USDS, but nonetheless, when you mint DAI, you can convert them to USDS, so it should be pretty easy. So the first thing to do is to connect with our wallet in MetaMask, okay? Okay, now it's checking the portfolio. In this case, I must be on the Ethereum mainnet, so I cannot use the token we have swapped on base layer 2. So basically here I will show you how you can mm, borrow DAI against it, but we will not do it because on Ethereum mainnet the costs for the gas fee are really high. So I just explained the process. So if you head over here to MakerDAO, you can create a new CDP position. Okay. So as you can see here, it says that creating a CTP allows you to generate DAI by depositing one of the supported collateral types. So you can support here a bunch of tokens, Ether, these other tokens here, Wrapped Bitcoin, whatever. I'm choosing Ether. So in this case, remember that there is the collateralization ratio. Let's say we want to mint 8,000 DAI and want to provide as collateral, let's say 20 ETH. There is a collateralization ratio of 500%. So if we reduce the collateral, let's say 10 ETH, you can say that the collateral diminishes. Let's say to it we are under collateralized, so we must provide I don't know 7 it to be here we are at risk. I think it allow us to do it, but we are very close to the liquidation ratio, which is 145%. And of course, once you create this you mint this DAI, you have to pay this stability fee each year. So this is the price to pay to mint this token. Another thing that I want to show you is to use the Sky savings rate that allows you to deposit USDS stablecoin and gain a reward. So we are in the Sky protocol DApp. We launch the DApp. Okay, we can go to savings. Okay, let's say that we want this is the Sky saving rate, which is 4%. Let's say we want to supply an amount. We need to connect the wallet. We are on base L2. Let's say we want to connect the wallet, MetaMask, connect. Okay. Okay, let's say that we want to provide, for example, 100% of our USDS. Okay, the rate is 4%. This is the annual percent rate of this of of the money that we will get. So we will be paid, we will accrue some interest by providing this amount of tokens. Okay, let's do this transaction. Okay, we need to do approve and then supply. Okay, we can bundle the transaction, confirm bundle to pay low gas fee. Let's see what happens here. Okay, execute function. Okay, here there is the approve. Here there is a swap. We are doing the swap. Let's confirm. Com. Okay, we should be able to see our transaction on base scan. Okay. I don't think we can, it will show, no, it won't show anything here because we haven't imported the contract. By the way, here if I go to balances, I can see the amount of money that we have supplied. So it will gain 4% a year. Let's say that now we want to withdraw the money, 100%. Okay, let's do it. Confirm bundle transaction. Okay, now we should have withdrawn our USDS. Now we should have them on our portfolio. And if I go to balances, now I should have zero. Okay, in fact, here is not showing anything. If we head over to MetaMask, we should able to see all the activity. So here you can see that we have swapped the USDS to SUSDS, which is the token that is used by the Sky protocol to accrue your interest. That's when we have deposited the USDS. And here there is the second transaction when we have done the withdraw. So we have exchanged the SUSDS back to USDS. Thanks for watching. If you have any questions or thoughts, feel free to leave them in the comments below. See you in the next video.